Good day. My name is Rossouw, and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. A key risk to global shipping is that either the Suez or Panama Canal is put out of commission. The Suez Canal, the busier of these two choke points, is currently blocked because a 200,000-ton container ship, the Ever Given, ran aground during a sandstorm on Tuesday, and so far canal authorities have been unable to refloat her. At present, nearly 300 vessels are waiting to pass through the canal, and it is still unclear when they will be able to continue with their voyages. As of last night, more than 126 million people have been infected with coronavirus worldwide, and more than 2.77 million people have succumbed to the disease. The United States remains hardest hit, with 30.8 million infections and over 560,000 deaths. Brazil, India, Russia, and France now make up the top 5, and South Africa has moved down to 17th in terms of most recorded cases. After 2 months of falling new infection rates, some of the world's major countries are now experiencing a concerning rise in new cases. Much has been said about the dire situation in Brazil, but that country is no longer an exception. India, home to nearly 19% of the world's population, has seen a sharp rise in infections, as has Germany, the Eurozone's giant. Vaccinations are not happening fast enough to arrest the spread of the virus by themselves, so we can expect periodic lockdowns to occur for much of the year. In Brazil, the daily COVID death toll has more than doubled over the past 2 months, and with the continued rise in new infections, the mortality rate is sure to continue rising. The country which pundits are most closely watching is India, with its massive population and inadequate health system. Britain has meanwhile dropped out of the top 10 worst hit countries thanks to its successful vaccination campaign and strict lockdown. As of Thursday night, around 287 million people have received at least one vaccination worldwide, while a further 111 million can be classified as fully vaccinated. In total, 5.1% of the world's population is now protected against the coronavirus to some extent. The United States is streaking ahead with over 130 million vaccinations, followed by China with 83 million, India with 53 million, and the United Kingdom with 31 million. To the EU's embarrassment, tiny Israel and Chile have each inoculated more citizens than Italy, Spain, or Poland. Economically, the key topic remains whether inflationary pressures are of a temporary or more lasting nature. Bond markets remain nervous, but yields have come off their recent highs. United States GDP growth and consumer price inflation have again been adjusted upwards, but the Federal Reserve remains confident that inflation remains under control. Britain and the EU have agreed to seek synergy in the production of vaccines, and the Eurozone's PMI is up sharply despite the lockdowns. US unemployment is nearly back to its pre-pandemic levels, and India has decided that charity begins at home when it comes to COVID vaccines. In testimony before the US Congress, Fed Chairman Powell and Treasury Secretary Yellen have painted a rosy picture of the US economy. Although GDP growth and inflation will be above average this year, they pointed out that this will be off low bases and that both variables will revert to their long-term average over the subsequent 3 years. With regard to inflation, they argued that only headline CPI is set to rise significantly, mainly due to rising fuel costs. They expect core inflation to remain subdued over both the short and medium term. Although the Fed views higher inflation as a one-off event, bond traders seem to be of the view that inflation is set to remain above the Fed's target level of 2% for longer. Over the past month, the yield on three-year Treasury bills, which price in medium inflation expectations, have risen by a third. This is a clear sign that there is lingering concern that the inflation genie is not necessarily going to meekly crawl back into his bottle just because Doctors Powell and Yellen told him so. Emerging market bonds fall and rise because of the same dynamics that drive developed market exchanges. When inflation fears cause yields in the G7 countries to rise, money starts to flow into these markets. The only way borrowers in the developing world can continue attracting creditors is for the yields on their bonds to rise. As can be seen in this graph, the recent spike in US yields caused a ripple effect in countries like South Africa, the dark blue line, Brazil, the green line, and Russia, the orange line. Most global markets have spent this week on the back foot, thanks to fears of higher interest rates or renewed lockdowns. The US dollar, on the other hand, is trading higher, which is bad news for commodity prices. Despite the gridlock in the Suez Canal, the oil price is also trending lower on softer demand. The explosion in the number of devices based on microchips has led to a global shortage, which has forced car makers to slow down production. And Naspers subsidiary Tencent is booming thanks to record profits from online gaming. The past 4 weeks have been a trying time for global equity markets, with this week the toughest of the lot. Taiwan was the only major market to advance, while the Russell 2000 in New York gave up nearly 5%. The DAX in Frankfurt was the top performer over 1 month, and the Chinese A50 the worst. For the year to date, the Russell 2000 is still in the lead, with the A50 bringing up the rear. Over the past 12 months, the Russell 2000 is still comfortably ahead, and the FTSE 100 the wooden spoonist. The Nasdaq is the top performer over 3 years, and the Hang Seng the worst. Last year, equity markets stole the limelight with some great returns, most notably the Nasdaq and S&P 500. The CRB Commodity Index, which includes not only minerals and metals, but also food and other agricultural commodities, had a solid if unspectacular year. This year the shoe is on the other foot. For the year to date, the S&P 500, the dark blue line, is up a mere 4%, while the Global Commodity Index, the red line, is up over 15%. In both instances, inflation is the driver. In the case of equities, it causes interest rate jitters, while commodities benefit from higher prices. The super low yields offered by bonds were largely responsible for the equity bull market of the past year. Equities attracted investors' capital because they pay dividends in most cases. The wider the gap in the yields offered by the two asset classes, the more attractive equities became on a relative basis. In the United States, share prices have risen much faster than dividends, unlike in Britain and the Eurozone. The dividend gap in the latter two blocks is still around 2.5%, while it is barely positive on Wall Street. This augurs well for pan-European equities in the months ahead. We remain positive about global equities, but we expect a continued rotation out of technology to more cyclical sectors. We also expect emerging markets to outperform developed markets, the East, the West, and Europe, the United States. The biggest risk to the equity market is rising bond yields. We remain skeptical about fixed income where yields are still negligible. We worry about the inflation fears that could trigger a fully fledged sell-off. We remain neutral about property, which, whilst cheaper than pure equities and yielding better than bonds, are Locally, the week was dominated by the ongoing spat between former President Jacob Zuma and the State Capture Commission chaired by Deputy Chief Justice Raymond Zondo. Zuma steadfastly refuses to appear before the Commission, and Judge Zondo has laid contempt charges with the Constitutional Court. If the APEC Court finds against Zuma, he faces 2 years in jail. His supporters, most notably the MK Military Veterans Association, have threatened to use violence to defend him against what they describe as a politically motivated witch hunt fomented by enemies of radical economic transformation. As of Thursday night, over 1.5 million South Africans have tested positive for COVID-19 and nearly 53,000 people have succumbed to the disease. Yesterday's death toll was 163. Sadly, only 220,000 people have thus far received vaccinations. Experts worry that the Easter holidays, when millions of South Africans travel to religious and family gatherings or holiday resorts, will result in a renewed surge in infections. Winter is also approaching when people tend to congregate indoors due to the weather. The next hard lockdown is probably just weeks away. The President's Medical Advisory Committee has urged Cabinet to be proactive and tighten the lockdown before Easter. Consumer price inflation is now below the Reserve Bank's target band of 3 to 6%, so the Monetary Policy Committee left interest rates unchanged on Thursday. The committee did warn, though, that inflationary pressures were mounting and that rates might rise in the coming months. The Banking Association has again warned of the negative impact expropriation without compensation would have, and South Africa is set for a record maize crop. According to the DA, 37,000 state employees applied for COVID relief grants even though they received their usual pay, and there is still a chance that the Lions tour might go ahead after all. Thanks to historically low consumer price inflation, the Reserve Bank has been able to keep interest rates low during the pandemic. On Thursday, the Monetary Policy Committee decided unanimously to keep the repo rate at 3.5%, its lowest level in more than 4 decades. Governor Ganyago did, however, warn that higher fuel and food prices could reignite inflation over the coming months and that the bank may be forced to hike rates next year. Such hikes would probably be small, most probably 2 25 basis points increases, one in the second quarter and another in the fourth quarter. Food price inflation thankfully slowed down a little in February, which helped to bring the overall rate of consumer price inflation down to 2.9%. Food and beverage consumer prices, the light blue line, rose by 5.2% year on year and made up 0.9% of the total CPI rate. What is concerning with a view to the future is that food producer price inflation, the dark blue line, remains stubbornly high at around 7%, due mainly to sharply higher fuel prices. Over time, higher production costs will inevitably push consumer prices higher as well. Maize farms in South Africa have become very efficient businesses in recent years. This infographic portrays how, over the past 50 years, farmers have managed to produce more and more maize on fewer and fewer hectares of land. Production, the brown bars, has doubled from 8 million tons to 16 million tons per annum, even as the area under cultivation, the blue line, has fallen from 4.5 million hectares to just 2.5 million hectares. Thanks to mechanization and improved farming methods, the yield per hectare, the grey line, has risen from 2 tons in 1971 to nearly 6 tons during the current season. After a 4-day losing streak, the JSE All-Share Index enjoyed a strong Friday and rose by over 3% on the day. Resources led the way and rose by 4.97%. The bond market has been on the back foot, however, and the 10-year SA 2030 is currently yielding around 9.5%. The rand is flirting with the 15 rand per dollar level, and Sanlam CEO has warned that South Africa should brace itself for 2 more COVID waves before the end of the year. SA Express is about to be liquidated, and the business rescue practitioners trying to salvage South African Airways have indicated that they are ready to throw in the towel. It has been a good week for both the JSE and the bond exchange from a foreign flows perspective. Foreigners were net buyers of nearly 1.2 billion rands worth of equities, and they also bought nearly 700 million rands worth of bonds. For the year to date, however, the picture is less rosy. The JSE has suffered an outflow of more than 8.2 billion rand, while the outflow from the bond exchange is approaching 30 billion rand. As is the case with most other emerging market currencies, the rand has been buffeted by the resurgence of the US dollar. It spent most of the past week sliding ever so slowly from around 14 rand 70 per dollar back to 15 rand to the dollar. Fortunately, our balance of payments is currently in surplus, or else the local currency could have been far worse off. Locally, the equity market has been strong so far this year, but valuations are still fair and prospects for earnings growth look promising. Real bond yields remain attractive, but we remain mindful of risks to the fiscal outlook going forward. We continue to avoid listed property and regard cash merely as a liquidity tool because of the low interest rate it offers. The Adviceworx PCS asset allocation view can be summarized as follows. Because of the economy and the weak rand, we remain overweight global equity and underweight South African equity. We remain neutral on global property where valuations are reasonable, but negative on South African property. We hold no global fixed income, and we remain overweight South African bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.